Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. A lot of data that the markets are analyzing, but of course the big one is some more granular details that we are getting around the US-India trade deal. Of course, we have a lot of ground to cover there, but nevertheless, markets are cheering the clarity that came over the weekend. And for now, the Nifty is up, so are the mid-caps. But look at banks. They are one-way movers and pushing the markets higher.
That's right. Good afternoon, Sonal. SBI clearly the outperformer and taking the banking index up along with it. A lot lined up on the show today, so let's start off with the top headlines. Market hold on to steady gains, led by gains in PSU banks, realty and consumer durables. IT emerges as the only laggard. Broader markets outperform.
A strong December quarter for Shipping Corp sees the stock surge over 13%. The company's revenue sees a 23% uptick while profit more than doubles.
Shares of Crompton Consumer surge over 5% on the back of an inline December quarter. Revenue growth led by ECD and lighting segment. We will be speaking to the management shortly. Stay tuned.
Sun TV rises in trade post Q3 earnings. The company reported muted growth and lower profit, but IPL valuation optimism outweighs December performance.
And shares of PSE and REC in focus as investors await further details of the structure of the merger. Bernstein says that the merger is not a straightforward one and the move is set to yield a bigger benefit for PSE shareholders.
Okay, all right, those are the top gainers. Of course, the biggest moves in the banking space. Even the mid-caps are outperforming the benchmarks, 1.3% higher in the mid-caps. The small-cap index is also surging in trade. We'll discuss all of it in greater detail. But for now, there's some update on the MSCI and the additions and the deletions we'll see there. Tell us more, Vivek.
Good afternoon. Well, that's right. So early February morning, so when we come into trade on February morning, we'll have the list, the February list. Remember, this particular list is not an all-comprehensive one, given the fact that no free float changes will be made by the MSCI in this particular quarter. The other thing to remember is that India's weightage in the MSCI emerging market basket has dipped sharply and now stands anywhere between 14 to 15% from the lofty over 21% that it stood at last year. This is mainly due to the underperformance of India versus the other emerging markets. In terms of the individual names that we will be tracking, Aditya Birla Capital analysts flag this off as a likely inclusion candidate. Expect over $250 million of inflows. L&T Finance Holding is the other name that could go into the MSCI this time around. Federal Bank as well as Indian Bank slightly lower probability inclusions, but both of these names could make the cut. If not, they will be on the radar for the May review. On the other hand, a few stocks that could exit. IRCTC close to $140 million of outflow. Astrid close to $165 million of outflow. And Kalyan Jewellers despite the outperformance today, analysts have kept it on the radar for a likely exclusion on the back of the significant underperformance that the stock has seen, notwithstanding today's up move. So, Sonal, this is going to be a very important trigger for the market. This time, don't expect too many fireworks because no free float changes will be made. But despite that, you could expect a few sharp moves, especially in these stocks that we flagged off.
I think markets have seen enough fireworks in the last couple of weeks. But nevertheless, that helps. Thank you, Vivek, for that. For the markets, let's quickly take a look at what's happening to individual names. In the broader markets, we are seeing a lot of moves in specific names. And let's talk about that now. SCI is one stock which is surging in trade on the back of good numbers. So that stock is on our radar. Other than that, we have SP Apparels, of course, a beneficiary of the US-India trade deal. It's a textile player, so that one is surging 10.5%. Office Space Solutions is the other one, 10% higher on that one. PCBL is up 10% right now. A lot of chemical names also tend to benefit. There's Tirumalai Chemicals, Lakshmi Organic. All these stocks are higher in trade as we speak, so good going for these. Deepak Fertilizers is also up around 7.5%. We do have Dhanuka Agritech, which reported numbers last week, and that particular name is up around 7.5% in trade right now. There's Arvind Limited, which is up 6.5%. Godrej Properties, that stock was at a 52-week low, but it has recovered substantially from there, up 6% in trade as we speak. But let's talk about the big boy. Tata Steel posted an inline set of Q3 earnings with its margin beating CNBC-TV18's estimates and net debt declining during the quarter. Nigel spoke to TV Narendran, CEO and MD Tata Steel. Listen into what he had to say.
So, Nigel, the larger point is, yes, I think the US trade deal is positive for India, positive for the sentiments in India, and hence indirectly positive for Tata Steel. But coming back to coking coal, most of the coking coal we buy is from Australia, as you mentioned, because we use what are called stamp charge batteries in our plants in India. And for stamp charge batteries, the Australian coals and some of the Indonesian coals and some of the African coals are better. The US coals are not suited for stamp charge technology. We buy coals from North America for Europe, but for India, it's going to be largely Australia and a little bit from Indonesia and Africa.
So you don't see any big change in terms of your sourcing mix from the United States going by what we have on the table today. Would that be a fair estimate into India?
That's right.
What about export opportunities? Since we got to deal with the United States hasn't been a big export market from India. Do you see any incremental volumes because of this trade deal that's been signed?
Not so much directly as indirectly, because directly the US market has always been a market which was difficult to enter because trade actions are very swift there. And in the past, whenever we exported a certain volume, there's always some trade action, whether it's for tubes or wires or any of the other products that we've exported. So we're not really looking at US as an export market directly for steel, but many of our customers, like the auto component manufacturers, etc., export to the US. And that's an opportunity for us. And for some downstream products, of course, US will be a market.
Okay. All right. Mr. Narendra, let's get to the results then. I want to ask about the Indian operations. And I was looking at most sell-side notes. They're estimating that the EBITDA per ton could improve substantially. Will a 1,500 rupee improvement sequentially in the EBITDA per ton be a fair estimate going by the operating leverage, the higher steel prices? Though part of the benefit will be limited because of the spike in coking coal costs. So 1,500 rupees improvement in EBITDA per ton for India, possible?
Yeah, that's possible for this quarter.
All right. That's good news then. Can it be more than 1,500 rupees?
Let's wait and see. Like you said, coking coal prices are a bit of a concern. So far, the market seems to be quite strong based on all these sentiments which have changed. We had a good start to this calendar year, both for long products and flat products. Our product mix is improving because the facilities in Kalinganagar, particularly the cold rolling mill, galvanizing lines, they're all ramping up. We have the combi mill in Jamshedpur, which gives us high-end long products. So in many ways, not only is the volume growing, but also the mix is getting better. So 1,500 is fair as of now, and let's wait and see what happens in March.
Is there further leeway to increase domestic prices? We had the safeguard duty that did come in. We have a couple of price increases that have been pushed through. Are domestic prices now at par with imports? Could we see another price increase here in India?
Yeah, I think what has happened, in the last few months is that domestic prices, which were at a discount to import landed, has corrected rightly so and come to import landed and slightly higher. Normally, domestic prices used to be at 2,000 to 3,000 rupees per ton premium to import landed to factor the risk involved when you're importing, right? So I think we've corrected quite a bit and come closer to where we should be from that perspective. But I think what remains to be seen is the impact of coking coal prices, because at $250, it's quite high. So coking coal has gone up by $50 in the last 2 months. So let's wait and see if it stays that way or if it goes up further, because then that will force steel producers to seek better prices from the market to cover these costs.
How do you see the European business pan out then? Will it continue to remain soft in Q4 for both Netherlands and UK? Or do you think Netherlands see some improvement in Q4 in comparison to Q3?
I think both UK and Netherlands UK will show some improvement. Netherlands will also show improvement. Netherlands largely because we're going to be selling about 400,000 tons more in Q4 compared to Q3. So you're going to have significantly higher volumes. So while we've guided that the prices realizations will drop by about 30 euros, largely because of the mix, not because of the prices, but because of the mix, because we're doing additional volumes to some of the lower priced segments. But overall, I think Europe, particularly the continent, is looking good because of the actions on CBAM, the actions on trade quotas, import quotas. So we expect this calendar year to get better and better as we go along. Operationally, we're quite stable, which is reflected in our numbers. Our cost takeouts are going as per plan. So I think Netherlands is on a good track to keep improving its performance quarter on quarter, and will have a better year next year than it did. UK, we are challenged because market conditions are not great, and we have not had the policy support in UK as we've had in Europe. So neither is there a reduction in quotas, which we've been asking for some time, nor are there any safeguard duties. But we're expecting some announcements to happen soon. Internally, I think the team has done a great job by taking out a lot of costs. Okay. So they've done all that they could, but we need some support from the government.
All right, and you're talking about European prices improving due to the measures taken on reducing imports. And you're also hinting that it can move towards a US price band. Could you quantify it? How much does European prices improve in this year?
So if you really look at it over the last many years, typically Europe has been about $100 lower than US and $100 higher than Asia. So that's been or $100 higher than India. So that's been the general balance. But over the last 2-3 years, because of the actions in the US has gone to about $300 higher than Europe. And Europe actually moved closer to India prices, So that is changing. If you see in the continent, the prices have gone up in the last few months by 30-40 euros.
Okay.
We expect this gap between US and European prices to get bridged a bit, but it will not catch up with European prices because I think the protection given in the US is much more than the protection being given in Europe. But we certainly see this gap reducing between Europe and the US and the gap increasing between Europe and India.
Okay, all right. So approximately $100 per ton increase is something that we should be bracing for?
I think that's a fair expectation.
All right, that's in the European operations. So just to get to the point then, in FY27, does the UK operations break even? And does Netherlands, say, get back to $70-80 per ton run rate in terms of EBITDA per ton?
Netherlands can certainly get back to that level. Yeah, UK again depends on the actions from the government, which is what we're expecting some announcements during this quarter. Because the UK government themselves are feeling the pinch because they also own some of the steel assets, so they're running some of the steel assets in UK, and so they can feel the pinch themselves. Okay. So we hope that they will at least take the actions that Europe has taken to protect itself.
Okay, and Q4 FY26, could we see further debt reduction? Could you end the year, say, with a $500 million debt reduction or, say, $1 billion debt reduction? Q3 was a surprise. So by the end of this year, what could it look like?
Let's wait and see. I don't want to give you a specific guidance, but yeah, I think we brought back debt levels started. Actually, we are just slightly below where we started in April. It had gone up to about 89,000 crores during the first half of the year. We brought it down to 81,000 crores. So we are where we started in April. Let's see what we can pull back in the next 2-3 months. We are obviously watching coking coal prices because that has an impact on the working capital.
Well, the rising prices of coking coal could have an impact on working capital. That's the word coming in from Tata Steel management. Well, moving on, we'll now slip into a short break. We'll connect with the management of Crompton Greaves Consumer Electricals to decode their Q3 numbers. Stay tuned.
Welcome back. You're still tuned into Midcap Radar. Well, Crompton is on our radar, reported an inline set of numbers in Q3. With respect to analyst expectations, electrical consumer durables growth was driven by strong performance in pumps and BEE transition. Let's welcome Kaleeswaran Arunachalam, who's the Group CFO and Head of Strategy at Crompton Greaves Consumer Electricals. Mr. Arunachalam, thank you so much for joining in. Good afternoon. I wanted to get a sense of the demand trends right now. Last 2 quarters were challenging for the industry overall, but we did see festive season, GST cuts. Do you think that has converted meaningfully into better demand? What is the outlook for Q4 and the upcoming summer season as well?
Hey, good afternoon. I think to start with, we could see some of the GST benefits already yielding to demand picking up. If I have to give you a specific category like pressure cooker, which is part of our butterfly business, you saw the GST coming down from 12 to 5%, and we have seen almost a 40% growth on that business. So that's very positive. One of the major things that we have to complete for Q3 is getting compliant with BEE. So 70% of our portfolio migrated successfully into it. Not only migrated, some of our investment that we have done on technology long time back helped to ensure that the cost is also mitigated. So overall, it's been a great quarter from that perspective across all segments, and even margins have started to moving up in the right direction. Looking forward, Q4 is our bigger season. Initial trends are positive. We would see that it continues. Category after category, we are seeing that momentum coming in. Butterfly continues to do well. We expect the kitchen category overall to grow at about, say, 15% in the next 2 to 3 years. And Q4 also seems to be in the right direction. Fans and air coolers, largely a summer-driven business. Demand starts from, say, 3rd week of February is when we see the pickup happening, and then it goes up to April. Initial trends are pretty positive in those segments also.
Okay, Mr. Arunachalam, FY26, especially for the cooling segment, even fans was impacted on the back of longer than expected monsoon as well as very strong winter season. So FY27 on this slightly subdued base, what are the kind of initial estimates you're giving? Can you quantify the guidance in terms of top line margins, PAT, as well as the market share that you expect to maintain?
Yeah, see, I'll start from the later. I think one of the important metrics that we measure ourselves in the organization is market share. I'm first very glad to share with you that as we speak, even for FY26, our market share is moving up northwards across all categories. That's a very positive trend. So irrespective of where the industry goes, we are able to do things right and work towards consumer-oriented insights is helping us to win, even when the season is not in our favor. Moving on that direction, we would expect our business, while we don't give a near-term guidance, to grow at mid-teens, which is doubling our business in the next 5 years is what we're looking at. Aided to that, even FY27, we don't see anything to be different from that. Considering the revenue growth coming in, one of the things that we will continue to do is invest behind the brand. As an organization, we also talked about why is it important for us to be consumer-centric and get technology that backs that. So we launched Tech with Heart about, say, 1 year back. Today, even in fans, we have moved towards a platform-based organization rather than multi-SKUs at multiple places. It is giving us scale. It is also giving us an opportunity to improve durability and reliability of our products, which is also making us win with the consumer. A segment like BLDC, we are now seeing significant growth in the last 3 quarters. And you will probably get to hear about new product launches also that will happen in March, which will help us to deliver stronger growth in FY27 also.
Take that point. So, one of the segments that did well this time was solar pumps, which recorded 2 times growth on a YOY basis. You now are at 200 crore rupees in terms of solar pumps revenues in FY25. What will this number look like in FY26, FY27? The entire solar category, how bullish are you on this? And also, aren't you seeing a lot of competition here? Because a lot of companies are venturing into this one.
See, I'm happy to state to you that while we entered, whenever we enter a category, we enter for leadership. We started with fans. Today, we are not only India's number one, we are world's number one in fans. The same is replicated in geysers. You can take in residential pumps. Now we are a top 3 player in kitchen and so on and so forth. Even when we got into solar, there were 2 hypotheses on which we entered. One, we believe, considering the momentum that has been created by PM Kusum, the entire agri segment for pumps will move towards solar in the next 3 to 5 years. So we wanted to be ahead of the curve, get our library created, and we become a brand of choice for the farmers. That has really given us the momentum on driving this growth. Today, arguably, we are probably a top 3 player in solar pumps also. Solar pumps plus solar rooftop, we think there are a lot of back-end synergies that can also obtain when you don't scale the business on a linear basis, but you jump frog the growth, which is why we are bullish and we are looking at these 2 business combined to be about 1,500 crores in the next 2 years. This will give us scale. This will give us cost synergies across various sourcing components that we buy from. It will also give us an opportunity to win with the consumer ahead of time.
Okay, Mr. Arunachalam, you've announced a foray into the wires and cable segment. While there is no doubt that the TAM over there is quite large, it's also a pretty competitively intense sector. Analysts are speaking about margin dilution from this particular space. Your thoughts, and what is the kind of targets you've kept for yourself over there?
See, any category we enter, first, we are very clear on unit economics. Categories that don't make sense for us in unit economics, we don't enter only. Because everything is attractive, everything has got a tailwind, but it doesn't make commercial sense, we don't enter. When we talk about wires, we see there are 2-3 things that plays to our favor. We have got a brand that is very, very strong, and our market share in some of the markets are maybe at upwards of 40-50% in fans. Backed on that, there is a lot of strength in go-to-market also, which is also helping us to see which categories can ride on the same go-to-market and help us to scale up over a period of time. As I already talked about, we also understand what are the consumer issues that we have in a category like wires that is not yet addressed. So we are coming out with a meaningful value proposition which addresses a real consumer need in wires, and cautiously we would be scaling this up. Capital allocation has been one of the strengths of Crompton, where we disciplinedly put money behind investments, where we know that there is growth opportunities. At the same point of time, it doesn't dilute our ROCE or margins. 3 years back, when we entered into solar, one of the biggest questions that came in is, will it dilute the margins? Will it get the ROCE down? I'm glad to say that it has not gone that path. We will be disciplined on that.
Okay.
And we will go with the value proportion that is more consumer-oriented rather than a Me-Too product.
Okay. Take that point now, Mr. Arunachalam. The street definitely likes your numbers, up 6%, and the commentary is quite bullish as well. Most of the categories to grow 10 to 15% for the next 2 to 3 years. That's the word coming in from Crompton Consumer. Thank you so much for joining in today and giving us your thoughts on the outlook going forward. At the day's high, after the management interview, that's the commentary from Crompton Greaves Consumer Electricals. Slip into a break. Up next, we'll get you more on the markets and stock-specific action.
Welcome back to Mid-Cap Radar. Well, with the news that the mid-cap index has now surged almost 1.5%, and the small-cap index has further picked up steam in the last half hour or so. If you look at the small-cap index, it's up over 2.3%, and the banks continue to lead the recovery. With that, that's all the time we have on this edition of Mid-Cap Radar. Your stocks when we return.